So, what if I told you that the moments you feel the most confident about a trade are often the exact moments you're about to lose? Today, we are going to flip the entire script on market sentiment. We're pulling back the curtain on a timeless strategy that institutions use to profit from the totally predictable emotions of the crowd. It's an edge that most retail traders, well, they never even see it coming.
You know this feeling. We've all been there, right? You see a chart that looks like it's headed straight for the moon. You jump in, you're feeling great, and then, almost instantly, the price just falls off a cliff. Or the reverse. The market looks absolutely terrifying, you panic sell everything, only to watch it rocket higher the very next day. This isn't just bad luck, my friend. This is market sentiment at work, and you're about to learn how to use it instead of being used by it.
Okay, real quick, we have to do the important part. Everything we're about to get into is for educational purposes only. I am not your financial advisor, and trading, as you know, involves very, very real risk. The whole goal here is to arm you with knowledge, so please always do your own research before you put a single dollar on a line. All right, with that said, let's get into the good stuff.
So the first thing we've got to understand is the problem itself. I call it the sentiment trap. And honestly, it's probably the #1 reason why so many traders lose money. It's because they're trading based on their feelings, not based on a rock-solid strategy.
You know, it sounds super complex, but at its very core, market sentiment is actually pretty simple. It's just the collective emotion of everyone in the market. And you can almost always boil it down to two incredibly powerful primal forces, good old fear and greed. These two feelings, they are the engine that drives the entire herd. And this right here leads us to the central paradox of the market. When the crowd is absolutely euphoric, when greed is at its absolute peak, that is often the exact moment the market puts in a top. And on the flip side, when everyone is panicking, hitting the sell button, that is usually the point of maximum opportunity. The main takeaway here is simple, but it's so profound. At the emotional extremes, the crowd is almost always wrong.
Okay, so if the crowd is wrong at the extremes, who's right? Well, that's where the institutions, the big money, come in. See, they aren't playing the same emotional game as everybody else. They get this dynamic perfectly. And instead of playing the market, they play the other players. They're playing you. They're playing the crowd.
Look at this. This is the fundamental difference. The retail trader is purely reactive. You buy when you feel greedy. You sell when you feel scared. But the institution? They operate on cold, hard data. They do the complete opposite. They become the seller when everyone else is greedy, and they become the buyer when everyone else is terrified. Basically, they are providing the liquidity for all of your emotional decisions.
So, how do we get on their side? This is where the solution comes into play. It's called the counterflow strategy, and it's a framework built specifically to trade against these emotional extremes, instead of getting sucked into them.
This brings up the million-dollar question, doesn't it? If institutions aren't just scrolling through Twitter or guessing, how do they get a precise, objective read on what the market is feeling? Well, they don't use feelings, they use data. And one of their absolute favorite tools is this, the put/call ratio. It sounds technical, but it's an incredibly simple and powerful metric. All it does is it measures the total volume of bearish options, those are puts, being traded against the volume of bullish options, which are calls. It gives you this unfiltered, data-driven snapshot of what the crowd is actually doing with their money.
Now, this is the secret to Coda Ring. When that ratio is extremely high, it means everybody and their brother is buying puts, betting on a crash. That signals peak fear. What are the institutions doing? They're on the other side, quietly buying. When the ratio is extremely low, everyone's piling into calls, feeling totally euphoric, and that's the signal for institutions to start quietly selling. They use these extremes as their personal entry signals. Okay, theory is awesome, but let's get practical. How can you actually use this? We can break it all down into a very disciplined 4-step process for putting this counterflow approach into action.
See, this whole process is about building a case, not just jumping in. Step 1, you identify that emotional extreme using data, like a super high or super low put-call ratio. Step 2, and this is crucial, you don't act on sentiment alone. You confirm that the price is at a key technical level, like major support or resistance. Step 3, you look for the institutional footprints. Are there huge block trades happening in the dark pools? This tells you the smart money is making a move. And finally, step 4, only when all 3 of those things line up do you enter the trade, taking the exact opposite side of the emotional crowd.
All right, let's walk through an example. Imagine the QQQ is trading at $540. The headlines are glowing. Everyone feels like a genius. So you check the data, and yep, the put/call ratio's at rock bottom. That's step 1. Then you pull up a chart, and you see that 540 is a major historical resistance level. That's step 2. Then you see reports of massive institutional sell orders hitting the dark pools. Bingo. That's step 3, your confirmation. So while everyone else is loading up on calls, you fade the euphoria, and you enter with puts. The price rejects that resistance, the crowd gets trapped, and now you're trading with the smart money, not against them.
Now, it is so important to understand that this isn't some gimmick that works for a few months. This is an evergreen edge. The reason it is so consistently powerful is because it's not based on some fancy new indicator or a secret algorithm. It's based on the one thing in the market that never, ever changes: human psychology.
And what's really amazing about this approach is how versatile it is. In a raging bull market, this keeps you from buying that final euphoric blow-off top. In a scary bear market, it stops you from panic selling at the point of maximum pain, right when it's about to reverse. And in a choppy sideways market, it keeps you from getting emotionally whipsawed back and forth with the rest of the herd.
So if you only take one single thing away from this entire explainer, please let it be this rule. The moment the market narrative feels the loudest, the most obvious, the most certain, that is your signal. That's your cue to take a step back, check the data, and get ready to take the other side of that trade.
I really hope this breakdown of institutional strategy gave you one of those aha moments, a new lens to look at the market through. And if you did find this valuable, I'd really appreciate your support.
First, just take a second to hit that like button. It lets me know this was helpful. Second, I would love to hear from you. Share your biggest sentiment trap story down in the comments. Trust me, we have all got one. Third, if you want to keep learning about these institutional tactics, make sure you subscribe to Elite Trade Radar for breakdowns just like this one. And finally, turn on that little bell for notifications so you do not miss the next explainer. Thanks for watching, and trade smart.